All right, everybody, it's 7 o'clock. Let's get this started. My name is Matt Binder. I work here at the Schaumburg Township District Library. Thank you so much for joining us tonight. It looks like most of the bad rain is over. Not that it matters because we're all inside anyway. Where I would like to welcome a regular here at the library, Mike Heatwole, who's going to talk tonight about optimizing your Social Security. Thanks so much for coming. And if you have any questions during the presentation, please make use of the Q&A function at the bottom of the screen. And that way Mike can answer your questions as he's going along. All right. And welcome to Mike, and I'll have him take it away. Thanks so much.
Thank you, Matt. Appreciate it. So thank you everyone for coming tonight. I'm going to go ahead and share my screen with you so that you've got that. Hopefully everyone can see that. And as Matt had mentioned, throughout the presentation, I will stop and ask for any questions. And so I'll take a look to see if anyone has submitted their question through the Q&A. Now to do that, you just go to the bottom of your screen and you'll click on the Q&A button. You'll type your question in there and that'll allow me to see those as we go along. So again, every 10 minutes or so, I'll stop for those questions and make sure I get those answered so we're following along together. My name is Mike Heatwole. I'm a financial planner with the Dollar Group is the name of my company, and it's in Hoffman Estates, right off of 90 and 59 there. And so I've spoken at Schaumburg Library probably for the past 7 years or so at this point. And so, talking about Social Security for the most part. So what I'm going to do tonight, we have a lot to cover. I'm going to dive right in. But before I do that, Matt did send out a couple of items to you through email. So hopefully each of you got those. The one that I want you to keep handy is that quick reference guide. It says 2020 quick reference guide. There's some numbers on there that we're going to talk about and a few tables that we'll use to reference. So again, keep that handy. If you want to, you can print that out as well. So let's go ahead and get started here. Before I go too far into the presentation, I want to, let me just make sure my clicker is working. There we go. I want to introduce you to my family. So this is myself and Linnea. We've been married for 13 years now, over there on the right. And that's our two little girls. So we've got Elin, who is 4.5. And she's right now working on her reading. So she's extremely excited about the letters that she's learning. And then she's also working on swimming. So she just made it to the swim class number 2, where she doesn't have to wear the floaties anymore. So she dives off the little platform and tries to swim to the other side by doggy paddling. And then the middle one is Audrey. So she's the baby. She's almost 7 months old now. And so she's working on crawling. She's also standing on her own. So we're close to that walking phase. We probably got another month or 2 before we see those steps, but that's going well. So the bottom left-hand picture is the last piece of the family. That is Linnea's dad. And so the reason we put that picture up there is that Linnea and I were in high school when we met. I was a senior in high school and she was a junior. And her dad at the time was her only parent. Her mom had died earlier of breast cancer when Linnea was 8. And so Linnea was the only kid in the house. Her 2 sisters were much older. So when I came on into the picture and met Linnea, she had asked me to sit down with her because she was seeing bills piling up on the kitchen table. So her and I started to look through things, and we had found that after her dad's stroke, he had a stroke about 4 years earlier. After that stroke, he had gone from, a nice retirement nest egg and being ready to retire in his mid-50s to about $40,000 left in the span of about 4 years. And most of that money was lost because he had given money to charities, friends, family, anyone who was asking, because cognitively he was declining due to the stroke. And so no one knew that. And obviously Linnea at the time when he had his first stroke was 12. So she wasn't able to help either. So by the time that we started looking through things, we didn't have a lot of options at that point. So we did decide to become his caregivers for the years of college. So all throughout college, we were his caregivers and lived with him. And then after college, he needed too much care for us to continue to provide that. So we had to decide to move him into a facility. Again, because he didn't have money, we had to make a choice as to whether we're going to move him into a Medicaid facility here in the US, or move him back to Sweden where he was a dual citizen. Now, he had always told his family that he wanted to go back to Sweden. He knew the care that they provided through the government healthcare system that they had there. And his brother also lived out there and spoke the Swedish language, so he was able to help. So the three daughters, Linnea and her two sisters, made the tough decision to move him out there. And we were able to go out there a couple of times. So that picture was taken in a Swedish nursing home before he died in 2016. And so I just tell that story and give you kind of a brief introduction to who I am, because it has a lot to do with why I am a financial planner and why I work mostly with retirees, is because it's important to me to be able to cover all of those main topics of, what happens if a, disabling medical condition occurs, or what happens if you can't make decisions on your own later on down the road. What do we want? What are your wishes? And what do we want family members to know in terms of their responsibilities when that happens? So that's just a little bit about me. I'll continue moving on here with Social Security because I know that's what you're here for. So Social Security's outlook, I put this slide up there because it's important for us to tackle whether Social Security will be around. That's the first step before we talk about how to optimize your benefits in Social Security. So with Social Security, on your benefit statements right now, if you look on page 2, what you'll see is there's a paragraph right in the middle of the screen, and it talks about how the Social Security Trust Fund is funded until 2035. That's when they're estimating that it will run out of funds. Now, that does not mean that benefits will stop, but it does mean that there's likely a benefit cut coming down the pike here, but we just don't know when. So currently, again, they're saying 2035 is when the fund would be depleted. When that happens, they are estimating currently a 20% benefit cut across the board for all retirees. And so the reason for that is because once that trust fund is depleted, that's currently what they're using to cover the gap between the taxes coming in versus the benefits going out. And so when there's a shortfall there each and every year, like there is now, they're taking from that fund to cover that shortfall to provide full benefits. Now, once we get to 2035, we won't have that fund anymore. And so the taxes coming in are going to have to match the expenses going out, the benefits being paid out. So in order to do that, they're estimating a 20% benefit cut. The one thing that I can tell you that's somewhat of a silver lining is, again, I've been doing these for 7 or 8 years now. When I started the Social Security presentations, those benefit estimates were a 27% cut is what they were estimating. And they were estimating that to happen in 2031. So they are, they're extending it out, now to 2035. And instead of it being a 27% benefit cut, they're now talking about a 20% benefit cut. So at this point, that's really all we know about the system in terms of the financing of it. There's not a lot of other information available. And so that is a big unknown when you're trying to decide, which benefit to select as you move forward. So let's look at why we have a little bit of an issue here. This is one of the reasons. There's multiple reasons as to why the Social Security Trust Fund is being depleted. But one of them is that back in 1950, you had 16 and a half people for every one person taking benefits. So you had 16 and a half people paying into the system for every one that was taking it out. You now have 2.8 people putting Social Security taxes into the system for every one that's collecting benefits. And that's projected to be 2.3 by 2035. So you can see the big difference there between when it was started versus what it looks like today. All right, so let's talk about the basics of Social Security, because I want to make sure we're all on the same page here before we move on to some of the more complicated rules around Social Security filing. So the first thing that we want to cover is you really have 4 different ways that you can qualify for Social Security benefits. The first one is that bullet point that's there is you can qualify off of your own earnings. So what I mean by that is that if you've worked at least 10 years and paid into the Social Security system during your lifetime, you now qualify for Social Security retirement benefits. That's how you earn those 40 work credits. So here's what I mean is if we take in 2020, as long as you earn $1,410 at some point during the year, you get 1 credit. If you make 4 times that or above, you get your full 4 credits. The maximum is 4 credits per year. So it's the equivalent of having worked 10 years and earning those 40 credits. Once you've done that, you now qualify for benefits, but now we have to decide, or we have to understand how your benefits are being calculated. So the benefit is calculated, you can see that below, is the highest 35 years of earnings during your life. So you really have two different situations. You've got one, an individual who has worked 35 or more years. And for that individual, they take the top 35 and the rest don't matter. So what that means for you is if you fall in that category is that every year you work now and make more than you did in the first of those 35 years, you are increasing your Social Security benefits. Okay, and so that is true even after you file for Social Security, which a lot of people don't realize. Is that I have clients, for instance, that are working full time in retirement because they like what they do, and they're also collecting their Social Security benefit. And every year that they make more than the first of those 35 years, they replace that bottom 35th year, and Social Security recalculates their benefit even after they've filed, and they do increase it for them based on those new earnings. So keep that in mind in terms of one way that you can increase your Social Security benefits after you've already filed. Okay. The second situation is you don't have 35 years of earnings during your lifetime. Maybe you have 20. And so for that individual, they are including 15 zeros in that equation when they calculate the benefit. Now, that being said, for every year that you're working now, it will replace one of those zeros. So it is helping you even more so for someone who doesn't have 35 years is you're working, now does help you even more so than someone who has the 35 years already. So just keep that in mind in terms of the first bullet point of how you qualify off of your own earnings. The other three is you can also qualify, even if you've never paid $1 into Social Security, into Social Security taxation, you can qualify as the spouse of an eligible worker, as the ex-spouse of someone who qualifies, as long as you were married for at least 10 years, or as a surviving spouse. So if you are a widow and your spouse qualified, but you did not, you can still get a survivor's benefit. Those other three bullet points, I'm going to talk in more detail later on here. So I'm not going to cover much here in terms of the rules around those, but I will cover those. So I'm going to talk about the Social Security benefit statements and what to look for there, and then I'm going to stop to see if we have any questions. So again, make sure you're submitting your questions through that Q&A if you have any as I go along here. So with your Social Security statement, there's a couple of things to look for. Number one is how do you get your Social Security statement? So we have to address that first. So it's either been mailed to you, and if you have not received it in the mail, you can go to ssa.gov and you can register. So you'll go to ssa.gov. Up in the top right-hand corner, there's a sign in, sign up button. So you'll click on that. You click on the My Social Security button. And then once you get there, you'll register. The one, trick or tip that I have for you when you're going through the system is that it will ask you some security questions based on your credit file. Be careful to make sure that you're really understanding what they're asking, because they are a little tricky sometimes with those questions. So for instance, I've seen questions where they'll ask, who did you refinance your primary mortgage with back in 2016? And so they'll have a list of 5 different banks, and they may be listing the bank that you actually refinanced with. And then they're also listing the bank that now holds your mortgage, where it was sold to that bank later on. So be careful that you pay attention to the question they're asking. Are they asking for the bank that you mortgaged it, that you refinanced with, or the bank that holds it now? Okay. So again, just be careful, because if you get yourself locked out, which happens more often than we would like to believe, a lot of my clients get themselves locked out. And if that happens, it's a 24-hour lockout period. And if it happens again, then you're going to end up on the phone with Social Security to get it unlocked. Once you get through the system, you will be able to see your benefit statement. You'll be able to print it or view it as a PDF. And when you do that, it's a 4-page document. The first page doesn't have much information on it, so that one we're going to skip over here during this presentation. And the 4th page also just has text on it. So we're going to cover the 2nd and the 3rd page during the presentation today, because there's a couple of items I want to make sure that you're paying attention to on that statement. So let's jump right into that. So what I've done here is I've taken the 2nd page of your benefit statement. I've blown it up. Okay. So this is the top half of the 2nd page. And so on this page, what you can see is you're always going to see the top 3 lines are your benefit estimates at different ages. So the top one is always full retirement age. Then you have age 70, then you have age 62. Now, if you are beyond age 62, let's say you're 64 or 65, it's going to show it to you at that age, at your current age, not at 62, because 62 is not applicable anymore. So you'll see those 3 benefit estimates. Now, here's what I want to talk to you about is that with those benefit estimates, the top number is the number that they are calculating off of your top 35 years of earnings. Okay, so the 1851 in this case with this client, that is calculated off of the top 35 years of earnings. The other two, the age 70 and the age 62, are just calculated as a multiplier off of that 1851. So what I mean by that is that if you wait until 70, they are giving you an 8% increase, simple interest, from full retirement age to age 70. That's the longest you can wait and have it keep growing is age 70. So you wouldn't want to wait past then. So let's say I wait from 66 and 8 months to 70 years, then I'm waiting 3 years and 4 months. And so if I get 8% a year, that's 24% for the 3 years, plus, roughly another 3% or so for the 4 months. And so I'm looking at roughly a 27% increase on that 1851, which is where the 2344 comes from. Okay, so all of these numbers lead back to the 1851. So anytime the 1851 changes, these other two numbers will change along with it. Okay, so the age 62 benefit is what happens if you take it early. So now they're giving you a reduction because you're taking it early. So if I'm going from 1851 down to 1314, that's roughly a 6% decrease per year. Okay, so keep those two numbers in mind. 6% decrease per year, approximately 8% increase per year after full retirement age by waiting. The other question that always comes up is, do I have to wait the full, until my next birthday to get the 8% increase? And the answer is no, that's being added every month. So 8% divided by 12, so 0.67% is being added to your full retirement age benefit every single month that you don't take it, okay, up until age 70. All right, a couple more items that I'll cover here, and then we'll get to questions. So I'm going to take you down to the bottom of this page where it says, and you might have the little piece in the way down there if you have the bar like I do. So you might have to move that out of the way, but it says we based your benefit estimates on these facts. And it says your estimated taxable earnings per year after 2020 is $46,770. So for this individual, what that tells me is that the last reported income to Social Security was $46,770. So that's what they made in 2019, for instance. So the reason that matters is because that is the assumption they are making, is that you will continue to make that amount of money between now and full retirement age. If that is true, then these benefit estimates are going to be pretty close, right, to what you're actually going to receive. If that assumption is incorrect, and for instance, you are retiring at 62 and not taking your Social Security benefits until 66, then you're actually going to have 4 zeros in there, right, in that equation instead of the 46,770. So what you have to do at that point is change the assumptions that are being made. And the way to do that is to use the ssa.gov website. They have an online calculator where you can plug in your earnings over your lifetime. You can also log in and it'll pull that in automatically. And then you can actually tell the calculator that you're not planning on working after 2021 or after 2020. And then you can have it recalculate those estimated benefits based on that new fact, that new assumption, and you'll get a new estimated benefit so that you can understand how much that will affect your benefits. So please keep that in mind when you're looking at those estimated benefits, that they are exactly what they say, estimated based on an assumption that's being made there. All right. So the other pieces on this page is your disability benefit if you were to become disabled and qualify for Social Security disability. And then survivor benefits. Survivor benefits we're going to talk about later in the presentation. Disability I'll cover just real briefly here. What I'll say is that disability is really like a 2-hour presentation on its own. Social Security disability is extremely complex. It's got a lot of moving parts that that all connect back together. And so you really need to work with someone who's a specialist in that area if that applies to your family. That is not myself. I don't have that experience and expertise, but I can get you to somebody who does. So if you really feel like that's something you need, let me know and I can get you the right person. That being said, the way that it works is that if you go on Social Security disability, that amount that you're collecting for disability, once you get to full retirement age, it just switches over to a retirement benefit and that amount stays the same. So for instance, this individual, if they started going on disability at age 55, like my father-in-law, they would collect $18.26 per month. And then when they get to full retirement age at 66 years and 8 months, they would continue to continue to receive $18.26 per month for the rest of their life. Okay. It's just in the system, it goes from a disability to a retirement benefit at that point. So you don't have to qualify for that retirement benefit anymore. So, all right. we're going to talk about page 3 now here. Well, let me get it. There we go. All right, page 3 of your benefit statement, and then I'll look at any questions that have come in. So on page 3 of your benefit statement, I have blown this up. So many of you, if you've looked at your benefit statement, you know that it actually shows your earnings from like 1970, 80, 90, 2000s, 2010. And so you've got all those earnings for the past 40 years. And what you're looking for is you want to look for any big errors. So any year where something was not reported to Social Security, and you know it should have been. So for instance, 2011 for this individual, they've got numbers in every single row except for 2011. And, you know, if this person was sitting in front of me and said, I know that I was working in 2011, I paid into Social Security, there should be a number there. Then at that point, the only way to get that changed is by providing a tax return to Social Security to get that updated. So what that means is that it's a whole lot easier to fix your earnings record errors if you catch them quickly versus, 20 years after the fact. So I've had this happen twice in the 8 years that I've been doing the seminars, where we had to try and get that corrected. And in both cases, it was back in the 90s. And so they didn't have tax returns, and it was a big mess to try and get that updated. So please be reviewing your Social Security statement once every 2 or 3 years at least, so that you're looking for any of those big errors in terms of the reporting that's coming in. All right, I'm gonna look down here. Doesn't look like we've had any questions come in, so I'm gonna keep going. Again, if you have questions, feel free to put them in that Q&A. So on the Social Security strategies, we're gonna cover a couple of items now that we've talked about the basics. And so with Social Security strategies, let's start with individuals. So for an individual, the first thing that I want to cover is, before I go into this graph, this does not apply to married individuals. It does not apply for divorced individuals or for survivor benefits, okay? We're only looking at a single individual who has not been married, doesn't qualify for divorce benefits. All of that other stuff is off the table. And the reason we're looking at this is it's called a break-even chart. So we're trying to put together a simple chart just so we can understand how long does it take to make back the money that we left on the table. And here's what I mean by that, so I don't confuse you. If I'm a single individual and my full retirement age is 66, okay, I can collect $2,000 at 66, which is the gray line that's there. So I have an option. Do I want to take it at 62, 66, or 70, or somewhere in between? And so what I've done is I've just shown, if I take it at 62, I'm going to get $1,500 a month, which means that annually I'm going to collect $18,000 a year from Social Security starting at 62. So from 62 to 66, that would be $72,000 that I collect from Social Security for those 4 years. So if I don't take it at 62 and I wait until 66, I want to know how long does it take me to make back up that $72,000 that I didn't take. So for this individual, because they would receive $2,000 a month versus the $1,500 a month, that's an extra $500 a month, which is an extra $6,000 a year. So if I take 72,000 divided by 6,000, that's 12 years. So what that means is that for me, if I wait till 66 to take it, I have to live past 78, so 12 years later, before I start coming out ahead in that decision. Now, if I wait until 70, I have to live past 82 in order for me to come out ahead with that decision. Now, of course, the other big unknown when selecting a strategy is we don't know when we're going to die. So the only thing we have to go off of is longevity in the family and whatever your current medical conditions are that you know about. So if there's anything that you know about that would limit lifespan, then that may be a reason to file earlier. If all of your family has lived into their 90s and you are healthy as far as then we make the assumption that you may make it into your 80s or 90s. And so then it could make sense to go to 70. So those are some of the things that we take into account when we're trying to think through those possibilities. The other thing that I'll mention here, and I'll get into more detail later, is that anytime you're trying to file early, so for this single individual, if they tried to file before 66 in this case, we would have to be really careful about how much money they're earning, because there is an earnings limit on anyone trying to file for Social Security benefits before full retirement age. And those earnings limits are very little. So in 2020, it's about $18,200. So for anyone making over $18,200, it probably doesn't make sense to file for their Social Security benefits until they get to full retirement age or until they've retired. So again, I'm going to cover earnings limits later in terms of how that works, but I just wanted to mention it here so that in your mind, you can start to think about that in terms of how that would affect your decisions. All right, let's go through married couples, and then I'll take a look at the Q&A and see if we have any additional questions that we need to stop for. So for a married couple, we've got filing for your own benefits, filing for spousal benefits, and filing for restricted spousal benefits. So filing for your own benefits is the one we're going to start with. It's the easiest one to kind of get our mind around. So for this, we're going to use a scenario, Tom and Mary. It's a married couple. Tom is 66, Mary's 63. And so their full retirement ages are 66, each of them. So Tom can collect $2,500 a month at his age 66, and 3 years later, Mary can collect $1,200 a month at her full retirement age at 66. So the reason there would be that much of a gap between the two is that either Mary didn't work a full 35 years during her career, or she made basically half of what Tom made during her career. Okay, so it's important to keep in mind that these strategies work either direction. It doesn't matter which spouse is the higher earner. And so at this point, just keep in mind that these strategies work both directions. We can flip these and it works the same way. So just pay attention to the rules as we go through the spousal piece, because that's going to be important here. So with our own benefits, really simple. He's collecting $2,500, Mary gets $1,200. Now, the one thing that happens with Social Security is that when Mary files for her benefit, Social Security is going to look at whether she is eligible for a spousal benefit as well as her own benefit. Okay, so when they look at this, they're going to say, okay, Mary can collect $1,200 off of her benefit, or she's eligible for a spousal benefit, which is half of Tom's, which is $1,250. So in this case, they're actually going to give her $1,250 a month instead of the $1,200 a month. So between the two of them, they would be collecting $3,750 a month once Mary files. And that would be the case for the rest of their lives until one of them dies, in which case then we switch to survivor benefits. And I'll talk about that later. So again, following along here, if you're filing for your own benefits, $2,500 for Tom, $1,200 for Mary, but because she qualifies for the spousal benefit, she gets the $1,250 instead. So here's the rules around spousal benefits, because it's important to understand why Mary was eligible. So Mary has to have been age 62 or older to qualify, which is the case for any Social Security retirement benefits, okay, other than survivor benefits. And then they have to have been married for at least 1 year. So no shotgun weddings in Vegas, and then you're applying for spousal benefits the next day. You have to put up with them for at least a year before they'll give you the spousal benefits. The last 2 bullet points, your spouse must first file for Social Security. And then the last one, if claimed at your full retirement age, the spousal benefit would be 1/2 of your spouse's primary insurance amount. Now I'm going to show you what these last 2 bullet points mean in graphical form, because it's a little hard to understand. So let's come back here. The first thing we're going to cover is what happens if your spouse has not filed yet. So for instance, what if we had Tom wait until 70 to take his benefit so that he can get the 8% increase? So for Tom, he's going to go from $2,500 a month up to $3,300 a month from 66 to 70. So if he doesn't take it until 70, he's going to collect $3,300 a month. What that means, though, is that when Mary goes into file at 66, she will only get $1,200 per month because Tom has not filed yet. And because Tom has not filed yet, she can't collect a spousal benefit. She's not eligible for one. So she'll only get her own benefit. So in this case, Mary would file at 66, collect $1,200 a month. A year later, Tom files and collects $3,300 a month. And now what'll happen for Mary is that she will automatically get a spousal increase from $1,200 up to $1,250 per month, which is what her spousal benefit was supposed to be. Now notice that I did not say that she gets half of the $3,300. Okay, the spousal benefit does not increase along with your age 70 delayed credits. Okay, so by Tom waiting, that helps his benefit, and it also helps our survivor benefit, which we'll talk about later, but it does not help the spousal benefit. Okay, the spousal benefit is still only $1,250 a month. The same is true if Tom files early. So if Tom files early, let's say we had him file at 62, And instead of getting $2,500 a month, he gets $1,700 a month because he's taking it early. As long as Mary waits until her full retirement age, she'll still be eligible to collect $1,250 as the spousal benefit. She still gets half of his full retirement age benefit, even though Tom filed early. So with spousal benefits, what Social Security cares about is, has your spouse filed already? So that's number one. Is the spousal benefit bigger than your own? Because if it's not, then you would just take your own benefit versus the spousal. Okay. And the last piece is, are you full retirement age when you go to collect the spousal benefit? So as long as Mary is full retirement age when she collects the spousal benefit, she will get the full $1,250. If Mary files early, so let's say she files at 62 as well, then her spousal benefit and her own benefit will both be reduced by the 6% per year, and she'll get the smaller number. So let's say it was supposed to be $1,250 for the spousal benefit, and it's now going to be $900 because she's taking it at 62. And it'll remain at that $900 then for the rest of her life. It will not go up once she gets to full retirement age. So keep that in mind, is that there's a lot of rules regarding spousal benefits, but hopefully I kept you with me there. So let me just take a look at the Q&A here before I move on from spousal benefits. I do not see anything that's come in there, so I'm going to keep going. So with restricted application for spousal benefits, this is a strategy that used to be very powerful, and most clients were using this when they could. It's now a restricted application is now limited to certain individuals. And so only individuals who are born on or before January 1st, 1954 are allowed to use a restricted application strategy at this point. So most of us are not going to be eligible for that on the call. So what we want to make sure is that if you are eligible, you understand how this works. I'm going to fly through it pretty quick here because since it doesn't apply to many of us, I don't want to spend too much time there. But here's what it does, is it allows an individual to take just the spousal benefit and then let their own benefit keep growing. And so here's what that looks like. We're going to have Tom do the exact same thing. So he's going to take his benefit at 66, which is $2,500. And then when Mary gets to 66, she's going to take just her spousal benefit. So she goes in and files for a restricted spousal benefit. And so you can see it's $1,250, just like we had talked about before. Now, what's happening is because she filed for a restricted spousal benefit, her $1,200 benefit from her own earnings is still growing at 8% a year from 66 to 70. So when she gets to 70, what she does is she turns off the $1,250 spousal benefit and she turns on her $1,584. My screen is covering this a little bit. Yeah, $1,584 for the her own benefit that's grown at that 8% a year. So it's just important to keep that in mind in terms of a powerful strategy that you can use there if that still applies to you. And I'll skip through Tom's here just to keep our time in check. So with the ex-spousal benefits, what we're going to do is we're going to look at, this is very similar to spousal benefits. And so I'm going to look at a few of the rules around ex-spousal benefits. So you can see that here. So if you were married for at least 10 years, you are not remarried currently, and you are 62 or older and your ex-spouse is 62 or older, you qualify for ex-spousal benefits. So let me just kind of recap that quickly. Married for at least 10 years, that's pretty straightforward. You can understand that. You can understand that you're not married currently, because if you were married and you go in and file for Social Security benefits, it's your spousal benefits will be based off of your current spouse, not your ex-spouse. Okay. Now, it does not matter whether your ex-spouse has remarried or not. Okay. Social Security does not care in terms of whether you qualify for Social Security ex-spousal benefits. Now, the middle one is the most important, because it's different than spousal benefits that we just talked about. So remember, with spousal benefits, you have to, your spouse has to have filed in order for you to be eligible for spousal benefits. You can imagine how much of an issue that would be for ex-spouses, right? So if you had to wait for your ex-spouse to file in order for you to be eligible for an ex-spousal benefit, that could be a major issue, because you don't know when your spouse is going to file. You won't know when they did. And you're likely not in communication with them. And so a lot of those problems they foresaw. And so they put this rule in there that basically said, as long as your ex-spouse is 62 or older, and you are 62 or older, then you effectively are eligible for that spousal benefit if and when you want to take it, right? Now, all the other same rules apply. So if you take it before full retirement age, it's going to be reduced. You would compare that versus your own benefit, because if your own benefit's going to be higher, you would take your own. So all of those same principles apply with ex-spousal benefits. All right, let's talk about survivor benefits, and then I'll stop and see if there's any questions here. So for survivor benefits, there's really two main pieces that we have to pay attention to. So the first one is really, as a survivor, how much is my full survivor benefit? And then the second piece is, as a survivor, when do I want to take that benefit? So let's talk about the first one. You really have three different scenarios that could occur. Your spouse died after they filed for Social Security benefits, in which case your survivor benefit would be whatever they were collecting when they died from Social Security. You also have this case where your spouse was waiting until 70, for instance, and they died at 68. And so in that case, Social Security will give you credit for the fact that they were waiting. And so what they'll do is, let's say they died at 68 and their full retirement age was 66, they'll give you the extra 16% credits on their full retirement age benefit for the fact that they were waiting, and they'll act as if they had filed on the day of their death. And then the third case is they never filed for Social Security benefits and they're, prior to full retirement age, they die, in which case your survivor benefit will be very close to what's shown on their Social Security statement. So if you look at their statement in that year that they've died, you'll see the survivor benefits that is there. It lists it there on page 2 for you. And so now that we know which of those three scenarios it is, and so we know what the full survivor benefit is, let's call it $2,000 a month is your survivor benefit, then in that case, now we have to decide when are we going to take it. So we can take it as early as age 60, but keep in mind that anytime we take a benefit, Social Security benefit, prior to full retirement age, we have to deal with that earnings limit of $18,200 a year. So if you are a survivor, if you are a widow, and at 60, you thought you were going to be able to take your survivor benefits and supplement your full-time income, that's likely not going to work. Because if you're making substantially over 18,000, they're going to basically wipe out your survivor benefit because you're making too much money. So only survivors who are not working any longer or are making under 18,000 are going to be able to benefit from that, or taking that benefit early. Now, if you wait until full retirement age, then you don't have to worry about those earnings limits anymore. So in essence, if you wanted to, at full retirement age, you could take your survivor benefit, and Social Security system does allow you to switch over to your own benefit at age 70 if you chose to do so. So if your benefit is going to grow higher than your survivor benefit, then you could switch over to your own benefit later on. So again, I'm happy to answer any questions on that if you have something specific that applies to in terms of your situation. So again, we're going to look at the Q&A, and if you have questions, feel free to submit them down there. I do want to cover this quickly. I've got one slide here that's in regards to public pensions. So if you have a pension from the teacher retirement system, SERS, which is community college professors or staff, or you've got a civil pension, so like a city pension. Police officers will have this a lot, where you've got police officers or firefighters have these types of pensions. So if you were an employee in the federal system or the city system where you were not paying into Social Security, you have to deal with these two provisions: the WEP, Windfall Elimination Provision, and the GPO, which is the government pension offset. Now, I'm not going to cover them in this seminar because it probably doesn't apply to a lot of us. But if you want specific questions answered, feel free to stay on afterwards. I'm happy to answer those questions, or you can send me an email. And so I've got a few slides here. I'm going to cover it quickly. So with Windfall Elimination Provision, that is how Social Security will reduce your Social Security benefit from your earnings. So in 2020, the maximum reduction is $470. And GPO is the offset on your spousal and survivor benefits because of that pension. So what they do is they take 2/3 of the pension amount, they reduce your Social Security benefits by 2/3 of the pension amount. So just keep that in mind if you have one of those pensions. All right, a couple of miscellaneous provisions that Social Security has that are important to be aware of. One is retroactive benefits. So if you are in the on the webinar tonight and you find yourself realizing that you should have already filed based on the information that we've covered, you could actually go to Social Security and let them know that you would like to backdate your application, and they will do that up to 6 months. And what they would do then is they would cut you a lump sum check for those 6 months that you would have been receiving benefits. Okay, so it's just something to keep in mind. There's also one I don't have a slide on, which I call their oops provision, where you made a mistake. So in the past 12 months, if you had filed for Social Security already, and you're now on the webinar and realize that you shouldn't have filed, and that you made a mistake and you should have filed a different way, you can actually go back into Social Security, pay them back the gross dollar amount that they've paid you, no interest due, no penalties. You just give them that, you write them a check for that amount, and they will act as if you've never filed. Okay. Now you can do that once during your lifetime. And again, you only have a 12-month window to do that. So once you're outside of that 12-month window, there's no going back. Whatever selection you made is the selection you have to stick with. So it looks like we did have a question come in. So I'm going to go to that here before I go to cost of living. Will you be covering situations where you are earning a salary after receiving benefits at full retirement age? I decided to continue working. AGI will be way over their limits instead of retiring, and I know this will increase Social Security taxes. What are the gotchas and ways to minimize taxes? Okay, yes, I will talk about that in terms of a couple of different, there's a couple of different answers to that in terms of the, how to minimize taxes. So give me a few slides here and I will get to that. Cost of living adjustment. Okay, so with cost of living adjustment, in 2020, the cost of living adjustment was 1.6%. In 2021, they've announced it already, and I believe it's 1.3% if I'm remembering right. I might be a little off there, but I think I want to say it's 1.2 or 1.3 for next year. So I'll get this chart updated for that. But what you can see here is that it's been going down in the past 10 years or so, and a lot of that's due to interest rates and the inflation environment that we're in. So when inflation and interest rates are low, you're going to see low cost of living adjustments. And so that's why we've been seeing these low cost of living adjustments. So just keep that in mind in terms of if you're planning on Social Security keeping up with your inflation of expenses in retirement, you really shouldn't. This is not the asset that will keep up with the inflation of like your Medicare premiums or inflation of other household expenses during retirement. You really ideally would have other assets, investments or savings that is earning an interest rate higher than what those are inflating. So for instance, medical expenses have been inflating between 5 to 7% a year. So ideally you would want to have at least some assets that are growing at 5 to 7% a year to keep up with that, if not more. So just keep that in mind. Social Security, it is nice that they give you a cost of living adjustment, but it's not enough to keep up with inflation. All right. So this is where I want to, the next couple of slides here are where we're going to tackle that question that just came in. So let's talk about, we've already talked about this a little bit, but let's talk about earning, too much money prior to full retirement age. So here's what I mean by that, is you really have 3 categories. If I collect Social Security early before my full retirement age, I have to deal with an earnings limit. If I wait until full retirement age, I don't have to worry about my Social Security tax or my Social Security benefits being reduced. So for instance, again, I have a lot of clients that wait, until full retirement age, they take their Social Security benefits, they get the full benefit, plus they have their salary that they're collecting and they move forward, right? Now, before full retirement age, for someone who has collected, they have to be careful with these earnings limits. And so you can see the 18,240 under FRA or 48,600 in the year of FRA. So here's what this means. If I use a quick example, if I'm an individual who has collected early and I am making $40,000 a year, if I round that 18,240 down to 18,000, just to make the numbers easy, that means I'm 22,000 over the cap, over the earnings limit. Because of that, they're going to take $1 off of my Social Security benefits for every $2 over the cap that I am. So in this case, I'm 22,000 over, so they're going to take 11,000 off of my Social Security benefits for the year. So if my benefit was supposed to be $2,000 a month, they're going to take January, February, March, April, May, and half of June's payment before they give me anything. And then I'll get paid out my full benefit for the rest of the calendar year. And then when we hit January, it'll start all over again where I get nothing for 6 months. And then I get the last 6 months of payments. So for most people, it does not make sense to file prior to full retirement age if you are going to be significantly over these caps. Now, they do give you a little leniency in the middle category, which is the calendar year of your full retirement age. So for instance, if you were turning full retirement age in 2020, then starting in January, between January and the month that you are turning full retirement age, you can make 48,600 divided by, it's a ratio. So if you turn, for instance, your full retirement age in August of this year, then we would have January through July that you would have as earning, period before full retirement age. So that's 7 months. So they would take 48,600 divided by 12, right? So that's roughly $4,000 a month times 7, because you had 7 months of earnings. So that's 28,000. So you'd be allowed to make $28,000 in that first 7 months of the calendar year before they start reducing your benefits. Okay. So it's just something to keep in mind. If you have the quick reference guide, these numbers in this chart is actually on the back, the second page on that PDF, and it's the top table so that you're not having to remember this. So I'm going to move on here. So this is where I'm going to talk about taxation to cover that other question that came in. So for individuals who are collecting, they've got Social Security coming in, so they're collecting their benefits, and they also have income, other income, whether it's earned income, capital gains, dividends, whatever it might be. Those are all included in something called provisional income. And what this is it's really the IRS is determining whether your Social Security benefits will be taxed federally. Okay. So if you live in the state of Illinois, your Social Security benefits are not taxed by the state of Illinois. Okay. So you don't have to worry about state tax on the income side, but on the federal side, you do have to think about this. So here's how this works. They take provisional income is calculated as the adjusted gross income plus non-taxable interest plus half of your Social Security benefit. Okay. So for those of you who do your taxes, adjusted gross income is really all of the income coming into your household. So that's earned income, it's dividends, capital gains, interest, you name it, 1099 income, any of that kind of stuff that's coming in and is being included as taxable income, it counts towards provisional income. On top of that, they add in municipal bond interest, which is that non-taxable interest piece. And then on top of that, they add in half of your household Social Security benefit. Whatever that number is, we then have to compare that to the chart that's on your quick reference guide. So on the quick reference guide, you've got a provisional income thresholds chart that's there. And it's the second page of that quick reference guide. Okay, and on that second page, at the very bottom, you'll see where it says the provisional income thresholds, and that's the table. So if you follow along there with me, let's say that I come up with my provisional income and it's $50,000 a year. Okay, and so for $50,000 a year, I look at that table and I'm married filing jointly, which means that I'm above 44,000. So I'm all the way over to the right where it says up to 85% of my Social Security income may be taxable. So for me, what that means is that if I was going to collect $2,000 a month from Social Security, they're going to give me a 15% discount in their eyes. And so they're going to bring my taxable income from $2,000 down to $1,700. And now that $1,700 a month is going to be added on my federal tax return as taxable income and will be taxed based on whatever tax bracket I'm in for that given year. So in my example, let's just say that I was, they brought it down to $1,700 of taxable income that goes on my tax return. And now I multiply that by 22% because I'm in the 22% federal tax bracket, which is the most common that's in retirement right now. And so, at least of my clients. And so with that, then what you've got is you've got 1,700 times 22%. So that puts us at roughly, let's call it $360 of taxes that I would have to pay. Okay, so what that means is that off of a $2,000 a month Social Security benefit, I'm going to have to pay $360 a month in taxes, in federal taxes. So my actual payment will only be about $1,640, right? Or $1,660. So when I'm looking at that, it's just important that you keep that in mind when you're thinking through cash flow in retirement in terms of how it's going to be taxed. When we're going through that process here. So I'm going to show you one quick example here of a planning scenario that may be helpful, but it looks like we've got, let me just pause. I'm going to stop my share real quick. And it looks like we had a chat. Okay, we had a question come in. So is the earnings wages or interest and stocks? Okay, very good question. So let's come back here. So I'm going to take you back to this screen because that's what the question is in regards to. So when we talk about the earnings limits, it is only earned income that is being applied towards this $18,240. So what that means is that, dividends, capital gains, interest off of your investments, any of pensions, annuity income, any of that kind of IRA withdrawals, none of that is included towards that $18,240. It's only earned income. So that's W-2, or if you're a 1099 contractor, that would count towards that income as well. So again, keep that in mind when you're talking about the reduction of Social Security benefits. Now, when we come here to provisional income is now where they include all of that stuff in there, okay? So the only thing that's not included in provisional income is Roth IRA withdrawals in terms of, income that's coming in the door. So here's a quick planning example for you to kind of keep in mind, for you to work with your accountant and your financial planner on, because it's something that may be helpful to you, in that if we have two couples and they both live off of the exact same income, which is $67,000 a year, so that's what they need for living expenses. If we have couple one take $25,000 out of an IRA, and couple two, instead of taking it out of an IRA, is now going to take $25,000 out of a Roth IRA, right? So that's the only difference between the two couples. One is coming from an IRA, the other one's coming from a Roth IRA. So they both pull $67,000 in income. With couple one, when we run the provisional income equation, they get $56,000 as their provisional income, which pushes them over the $44,000 in the table that you see there. So now their full Social Security benefit will be taxable, the 85%. With couple two, because it's coming from a Roth IRA, that $25,000 does not count towards the provisional income equation. So for that couple, they now have $31,000 as their provisional income, and they actually fall all the way to the left side of that table that we were just looking at, in which case none of their Social Security benefits will be federally taxed for this year. Now, notice that I said, we took couple one had $25,000 in IRA, couple two was $25,000 from a Roth IRA. The only way that couple two would be able to get away with that is, number one, they have to have enough money in their Roth IRA to be pulling money from it, right, as an income. And number two is that means that we are not yet at the age where couple two is forced to take money out of their IRA by the IRS. So many of you have heard of the required minimum distributions. They used to be at 70 and a half, where you had to start taking money out of your IRAs. That's now 72. It's now age 72 as of the end of last year. And so in this case, we are assuming that couple two is not yet at 72. So they are not being forced to take anything out of the IRAs. And so they choose to take it from the Roth IRAs in order to keep their Social Security benefits not taxed by the federal government. So they would be able to do that for, let's say, if they took it at 66, from 66 to 72, so maybe 5 or 6 years, they might be able to get away with not having to pay federal taxes on their Social Security benefits. Once the RMDs kick in and they have to take money out of their IRA, there's probably nothing more we can do on that end in terms of, eliminating Social Security taxation, unless we're giving it to charity or some other, function where we're, losing control of that money. So in any case, it's just something to keep in mind when you're talking to your accountant and your financial planner, is to have them run these projections and see if there's anything that can be done for you to save money on taxes on the Social Security benefit side. So hopefully that answers the question that came in earlier. Let's see if there's any other questions here. Okay, I'll keep going. All right, so that's the end of the Social Security piece. Now, what do I do as a financial planner? There's a couple of resources that'll be helpful to you. If you want to go to my website, thedollargroup.com, you'll see up at the top, there's an events tab, and you'll see Social Security resources. So you're welcome to click on that. And you've got 5 different PDFs that are there that you can download. Or, and this is what those look like, different flow charts for you to be able to understand whether you're eligible for the various benefits. And then we can also do a Social Security analysis for you if you want to sit down with me and go through your actual benefit statements, your specific financial situation as to when you're thinking of taking it. Both you and your spouse want to come in, that's fine. And we'll run that through the analysis software that I have and really kind of break it down to 2 or 3 scenarios that make sense for you. And so this is what those printouts would look like, where you have, each of you listed the ages at which we're going to take it based on whichever scenario we selected. And then it breaks down how much is a retirement, spousal, or survivor benefit so that you can understand the differences between the 3. And then it gives you that total annual household number. So you can start to kind of get an idea from a retirement planning standpoint as to how much you'd be receiving each year in gross dollars. And then the last column that's there is a cumulative. And what that's used for is really to compare the different scenarios. So you might say, Mike, what happens if I take it at 70 and my spouse takes it at 66? Or what happens if I take it at 66 and she takes it at 62? And we now put those next to each other and we say, okay, if you do, option 2 versus option 3, maybe option 2, where you can see, Tom's age 80, they've collected $776,000 from Social Security. Well, maybe that's option 2. And option 3, instead of 776, it's 805. And so we can start to see where those break-even points are for a married couple, so we can understand really how long do we have to live in order to make these different scenarios make sense. So that's really what that piece is for. If you want to do that, there's a couple of ways to do that. You can either send your information through chat, which is on here. If you do that, make sure that you send it privately to me. Don't send it out where it goes out to all the attendees. Or if you're more comfortable, you're welcome to just email me there at mheatwole@thedollargroup.com. And I just need contact information, so I have a way to get a hold of you and schedule a time. And we can do it virtually or in person these days. So again, the contact information I would need would just be email address, your name, and phone number. Now, there's no fee for this analysis. And the reason I do that is because I've done enough of these to know I want to be able to help you when you've come in for, a webinar or a seminar. And I want to be able to get you what you need so that you have your Social Security questions answered. And if you already have a planner that you've worked with for 10, 15 years and you trust them and you're not looking for a second opinion on your investments or retirement planning or anything else, that's fine. There's no charge for the appointment. I'll get it done for you, answer any questions that you have and send you on your way. For those of you who do want a second opinion, you're not sure if your planner is doing a great job for you, or you don't have a planner already, and you kind of want to look at everything along with Social Security, that's great too. We can do that during the appointment as well. And so, we'll go from there in terms of then I can explain fees and what it would look like to work together, and you can make a decision as to whether that makes sense. So either way is fine. Again, I don't mind, doing the work for you, even if you're not planning on becoming a client or looking for a second opinion. But if you want to do that, just send me an email or through chat, send me your information privately so that I can reach out to you. So let's see if there's any other questions. I'll leave that up. I've got a Q&A. Okay. So I do have one question that came in. So if the spouse takes Social Security at 66 and gets $1,000 a month, and then if I take Social Security at 70 and we'll get $3,000 a month, so then when I am 70, we get $4,000 a year. Okay. So the question is, if spouse takes Social Security, gets $1,000 a month, and then you wait until 70 and get $3,000 a month, then yes, you would be getting $4,000 a month total between the two of you once you get to 70 and turn it on. Now, the one piece that you might be missing there is that it looks like there's probably a spousal benefit in play here. So when you do file at 70 and you're collecting your $3,000 a month, your spouse might actually be able to get a bump from that $1,000 a month up to half of whatever your full retirement age benefit was. Okay. So if your full retirement age benefit was, $2,400 or somewhere in there, then your spouse may actually get a bump from $1,000 up to $1,200 once you file at 70 because of that spousal piece. So I think that's the one piece that you might be missing there. So you might actually get a little bit more than that $4,000 a month, but I'm not sure, without the full info there. So any other questions before we log off here? Looks like we are all covered. So I'm going to leave that up. Well, actually, I'll stop my share so Matt can. Matt, do you have anything left that you want to say?
Nope. Just thank you everyone for coming and watching, and thank you to Mike for his great factual presentation.
All right. Thank you, Matt. So I guess we'll go ahead and close it out. I don't see any more questions that came through. So.
All right. Well, thank you so much, everybody. Have a great night.